You have a lot of equity in your home, but you also have a lot of debt. Let's talk through your options. My first suggestion would be a HELOC, which is a home equity line of credit. This is especially a great option when you have a current interest rate that's pretty low. In a nutshell, a HELOC is essentially an open-ended line of credit where you use it almost like a credit card. You take the draw from the equity of your home, you can pay it down, and the credit line remains open for you to reuse, and you don't make monthly payments if there's no balance. In exchange, usually HELOCs do have a higher interest rate, certainly higher than your primary mortgage, and oftentimes they are adjustable rates. Additionally, they are interest only for the minimum monthly payment. So it's always recommended that you make more than the minimum required payment if you want to chip away your balance. Very similar to a HELOC is a HE loan, and that is a second loan against your home, also at a higher interest rate, but it is fixed with an even payment each month and a one-time draw. Now, in most cases, HELOCs and HE loans generally require that you have a higher credit score, preferably in the 700 range. So if that doesn't apply to you, let's talk through your other options. You could do a cash out refinance, either conventional or FHA or VA if you qualify. VA is amazing. This does start your loan from scratch, and you will be subjected to the current interest rates. And if your credit is on the lower side and you don't qualify to go VA and you have to go FHA, you will have mortgage insurance, even though you will still have 20% equity in the home, because you have to have far more than 20% equity in the home in order to even qualify for a cash out refi. If none of those are an option for you, there is something called a home equity agreement. It's a little controversial, but let me explain. Let me preface this by saying I do not offer these and I do not encourage you to go this direction. But if this is your only option, it could be worth exploring. Home equity agreements are second loans that you do not make monthly payments on. They are a one-time draw, they are attached as a second lien against your property, and in exchange, not only do you have to pay it back when you sell or a certain number of years have passed, you also are committing to provide the lender with a certain percentage of your equity. Most of them do have the option to pay these home equity agreements off early. I definitely encourage you to explore the fine print on these agreements, as each lender offers a slightly different package. Now, lastly, you could explore a personal loan, and personal loans could be good options, but they generally also require you to have slightly higher credit scores. And because they are not secured to the property, they always have a higher interest rate. In most cases, the rates can be in the high teens all the way up to 30-ish% I've seen.